The dollar is in free fall. Iran and the US just extended a ceasefire deal, geopolitical risk just got taken out to the back, and every risk proxy on the planet is screaming higher. But there is one asset sitting exactly at the point of maximum pain, the Australian dollar. It's 0.7166 right now, and it is staring straight into a brick wall of supply at 0.7204. Here's what most traders are completely missing. This is not a normal breakout setup. This is a liquidity trap engineered to hunt stops on both sides before the true expansion begins. In the next 15 minutes, I'm going to show you the one danger zone, the hidden opportunity, and 3 precise strategies with entry prices, stop losses, and profit targets already calculated. Grab a pen and write this down. There is only one invalidation level that defines the entire structure today, and if you don't know it, you're trading blind. Right now my instant market verdict is this: the intraday session bias is bullish but rigged for a fake out. The higher time frames are screaming strong buy, monthly strong buy, weekly strong buy, and right down to the 5-hour and 1-hour charts the momentum is aligned north. But the daily chart, the time frame that actually matters for swing positioning, is spitting out a neutral reading. That tension between the explosive lower time frames and the hesitant daily is exactly where the trap gets set. The number I need you to carve into your screen is 0.7088. If the Aussie dollar trades below 0.7088 today, the whole bullish thesis from the weekly chart gets invalidated. That is the floor of the value zone, and a break below it would signal that the ceasefire dollar sell-off has been fully priced and the market is now pricing in a China demand scare. Write 0.7088 in the comments right now. I want to see who is serious about trading this session. Now let's go top down on the technical deep dive because the chart is giving us a masterclass in compression and expansion cycles. On the weekly time frame, AUD USD is in a textbook trend continuation. We have had 4 consecutive bullish weeks with the most recent weekly candle closing well above the 50-week moving average. The MA200 on the weekly is sitting far below at the 0.6869 handle, which tells you the long-term trend is massively bullish. The daily chart is where things get nuanced. Price is currently wedged between 2 magnetic poles, the 20-day moving average at 0.7165 and the horizontal resistance band between 0.7204 and 0.7227. The 50-day moving average at 0.7125 is sloping up and has acted as dynamic support for the last 2 pullbacks, while the 100-day sits at 0.7029 and the 200-day rests at 0.6869. All 4 major moving averages are stacked bullishly, which normally would be a green light for a breakout, but look at the daily RSI. It's at 50.95, dead neutral, not confirming momentum yet. The MACD on the daily is printing 0.001, barely positive, just a whisper above the zero line. This is the signature of a coiled spring. Let's drop into the execution timeframes, the 4-hour and the 60-minute charts, because that's where the trapdoor is most visible. On the 4-hour, the trend is a strong buy. We have a series of higher lows right along a rising 20-period moving average that is currently at 0.7164, almost identical to the price. The MA60 on the 4-hour is at 0.7140 and rising fast, forming a bullish crossover with the MA20 that happened 6 candles ago. That crossover is the reason the 5-hour trend reads strong buy. Now come down to the 1-hour chart where the MA5 at 0.7154, MA10 at 0.7164, and MA20 at 0.7165 are all bunched together within a 12-pip range. This moving average bundle is acting like a trampoline. Every test of this zone in the last 2 sessions has produced a bounce, but every rally has been capped with precision at 0.7204. The 60-minute RSI is hovering around 55, not overbought, and the 1-hour MACD is producing small positive histogram bars, meaning momentum is gently tipping in the bull's favor but without any conviction. Now here is the structural insight that changes everything. Support is not just a number. The 0.7111 level is the swing low from last week's consolidation, and it aligns almost perfectly with the 38.2% Fibonacci retracement of the most recent leg higher. Below that, 0.7088 is the double bottom neckline and the 50% retracement. This 0.7088 to 0.7111 zone is where the stops of late longs are resting. Resistance is 0.7204, which is the prior swing high, and 0.7227, which is the 200-hour simple moving average plus the 61.8% extension of the April range. The market makers know these levels better than we do. The game today is to engineer a stop hunt above 0.7204 to trigger breakout buyers, then potentially reverse if the daily neutral structure refuses to follow. Or, they smash price through 0.7111 first to collect the weak longs, then launch the real rally. This is what I mean by a trap. You cannot commit emotionally. You need a plan for both scenarios, time to connect the fundamental driver and the cross-asset linkage, because this ceasefire headline is not just about the Middle East, it is a direct injection of risk appetite into global markets. Overnight, reports confirmed the US and Iran extended their ceasefire deal. The immediate reaction was a dollar sell-off. Why? Because a stable Middle East removes a supply shock premium from oil, lowers the safe haven bid for the greenback, and opens the floodgates for carry trades and high beta currencies. The Australian dollar is the ultimate China proxy and the risk barometer of the FX market. When the world feels safe, the Aussie rallies. But here's the critical cross-check. We need to watch the US dollar index. The DXY is testing key support at the 99.50 level as I speak. If that level breaks, AUD USD will not just test 0.7204, it will rip through it. The S&P 500 futures are also pushing against all-time highs, and the correlation between the S&P and the Aussie over the last 20 sessions is over 0.8. This means every tick higher in equities is a tailwind for our currency pair. However, the hidden risk is China. Tomorrow we get the official Chinese manufacturing PMI. The expectation is 50.2, expansionary but fragile. If that number misses, the Aussie will get hammered regardless of the ceasefire news because iron or demand expectations will fall. The 1 to 2 week directional lean remains bullish, targeting 0.7275, but only as long as 0.7088 holds. A close below that and the entire thesis is dead, replaced by a drop to 0.7020 that most people will click away now. But this next segment is where money is actually made. Keep watching because I'm about to lay out 3 trade setups with exact triggers, stops, and risk-reward logic. Strategy 1, the sniper, the conservative approach. You do not enter before the market proves itself. The trigger condition is a decisive 1-hour candle close above 0.7204. Not a wick, not a tap, a body close. Once that closes, you wait for a 15-minute pullback into the 0.7195 to 0.7200 zone, which is now expected to flip from resistance to support. Enter long at 0.7195. Your stop loss goes at 0.7175, below the breakout level and below the 1-hour moving average bundle. The logic is that if the breakout fails immediately, you want out fast. Target 1 is 0.7250. Which represents the measured move of the range projection and a round number. Target 2 is 0.7275, the upper boundary of the weekly volatility envelope. The risk on this trade is 20 pips. The reward to target 1 is 55 pips, giving you a risk-reward ratio of 1 to 2.7. To target 2, it is 1 to 4. What voids this setup? If price closes back below 0.7204 on the 1 hour after your entry, the breakout is false, and you exit manually or wait for your stop to take you out. Do not hold and hope. Strategy 2, the active trader, is the standard dip buying approach designed to exploit the moving average bundle. The condition is a pullback during the London or early US session that tests the 0.7125 to 0.7111 demand zone without breaking below 0.7088. You set a limit order at 0.7120, right on the 50-day moving average and inside the support zone. Your stop loss is placed at 0.7080, 30 pips below, giving the trade room to breathe below 0.7111 but still respecting the invalidation. The first target is 0.7180, a level just below the current price action high, aiming to bank 50 pips of profit. Once target 1 is hit, move your stop to break even. The second target is 0.7200, the top of the range. If you get there, you close the remainder or set a trailing stop of 25 pips. The risk is 40 pips, reward 1 is 60 pips, risk reward 1 to 1.5, but you can scale in and out for a superior win rate. This setup works because smart money often reloads long positions inside the moving average cluster before the real expansion. Before I give you the aggressive strategy, let's see how aligned we really are. Type your AUD USD range for tomorrow's session in the comments now. I want the high and the low you expect, for example, 0.7180 to 0.7230. I read these comments, and the traders who do this every day consistently improve their mapping accuracy. Drop your range now. Strategy 3, the aggressor, high risk and only for those who know how to lose small and manage risk aggressively. This is the momentum chase on the smaller timeframe extreme. You see the current 1-hour trend is strong with price sitting at 0.7166. The aggressive entry is a market buy right here with a tight 20 pip stop at 0.7146, just below the MA5 and the MA10 on the 1-hour chart. Your first target is 0.7200, a 34 pip gain. If that gets hit, you close half and let the rest run for 0.7225, the upper resistance. The total risk is 20 pips. The first target reward is 34 pips, giving you a 1 to 1.7 ratio quickly. But understand this, you are buying into resistance without confirmation. If the trapdoor opens and price reverses from 0.7190 without reaching 0.7200, your stop gets hit and you lose small. That is the trade-off. This strategy works only on days when risk appetite is surging and the US dollar index is actively breaking down. Today with the ceasefire catalyst, the conditions support an aggressive probe, but never allocate more than 0.5% risk on this style. The warning is explicit, only for those who can stomach a string of small losses in exchange for capturing explosive momentum. Risk management pulse. Never risk more than 1 to 2% of your account on any single trade. No positions through high-impact news like the China PMI release tomorrow. Stops are non-negotiable. If the market gaps, the gap is your risk, so size accordingly. Let's close this out with the only thing that matters for tomorrow's session. The one critical level that decides everything is 0.7088. Above it, the weekly strong buy structure is intact and the path of least resistance is higher with 0.7275 being the final destination. Below it, the trap has sprung in the opposite direction and we are likely heading into a corrective leg targeting 0.7020 and the 100-day moving average. Tomorrow's focus is the China manufacturing PMI. That number will either validate the ceasefire risk rally or expose it as a thin veneer over slowing global demand. I will be covering that live in my pre-Asia analysis, and the reaction in the Australian dollar will be instant and violent. If you want the full breakdown on the US dollar index and the S&P 500 divergence that is driving this entire move, that video is live right now on the channel. Check the end screen, click it, and you will see exactly why the DXY collapsing is not just a dollar story but a liquidity tide lifting every risk asset. Smash the like button if this analysis gave you a clear, actionable plan for the next 24 hours. Subscribe and hit the bell because we do this every single day across 8 key assets with institutional precision. I'll see you in the next one, where the US dollar index story gets even more intense. 本回答由 AI 生成，内容仅供参考，请仔细甄别。